Hello, everyone, and welcome to the show today. So today, we're going to be diving in. We're going to be talking about how to actually get a loan. And most importantly, we're going to be talking about how you can quickly and easily qualify yourself and your clients for business financing. You know, exactly what it takes to get what kind of financing. And we're really going to take a look at pretty much almost all of the financing options that are out there today. The ones you're going to walk into a conventional bank and get, and the one that you're going to get from actual alternative lenders. Now, this is a little bit different than what we usually do because I'm actually doing this live right now for our active partners, for our active clients. But you can see that I have some actual graphics on my slides, which means usually that's something I'm going to put out on YouTube as well, and probably even put out on our podcast as well, because I don't know when I think this information is going to be very useful for our active partners that are offering business credit financing as a service. But I also think an end user can get a lot of benefit from the same information as well, because we really outline here, and we're going to outline over the next hour or so exactly what it does take to qualify for financing. So you're going to leave this to know what kind of money you could get right now if you're looking for money, or you're also going to be able to leave and know exactly what it takes to qualify your customers really, really quickly for financing, so you'll know in a matter of literally seconds exactly what kind of financing they can get. So let's jump in. Let's get started. So I refer to this really as the 3 C's of lending. And there's 3 easy ways that you can qualify people for financing. And we're going to dive in and talk about each of these ways and what that actually means somebody is able to get regarding financing too as well. So that way you're not just stuck knowing how to qualify, but you actually know exactly what type of financing somebody can get. So the first C that we talk about when we talk about the 3 C's of lending is called cash flow. Does somebody have proven cash flow? Can they prove it through their bank statements? Can they prove it through their tax returns? There's different kinds of loan programs available depending on how somebody actually can get it, or how they can actually verify their cash flow. The other way to get financing is credit. Does somebody have good personal credit, or do they have a signer, a guarantor, a friend, a family member, a partner, somebody else in their circle that would be willing to let them use the credit as a guarantor to actually then qualify for credit financing? And the other is collateral-based financing. So with collateral-based financing, then we're talking about somebody that can actually has some kind of collateral. And this is somebody that has, and we'll go over different types of collateral that actually can qualify for financing, but this is somebody that might not have cash flow or credit, but they only have collateral. So what's beautiful about what we do and what you do as partners is that we only need one of these 3 things to be able to get somebody actually qualified for a loan. This is a really big deal, because when we talk about SBA loans, when we talk about what happens at a conventional bank, they need all 3. This is why it's always been, we've always kind of thought it's so tough to get money. So many people believe this because they're used to conventional banks where they've got to verify cash flow through bank statements and tax returns and P&Ls and projected financials and current financials. And then they have to have really good personal credit. I mean, really good personal credit. We've seen people at conventional banks get denied because they have one late payment almost 7 years ago, and they have a 780 credit scores. I mean, it's almost ready to drop off their credit report, but they still get denied because of that late payment. And then banks also require collateral. As a matter of fact, they often require 50% of whatever you're borrowing as some kind of collateral. So most people we talk to just don't have these. They just don't have cash flow, credit, and collateral, all 3. But we talk to a lot of people that actually have one of the 3, that have a strength. So what we like to say is, if you have a lendable strength, then you can get financing, and it only needs to be one of these 3. Now, this is a pretty big deal, because I'll give you an example. I saw a Facebook ad or post or something we had out the other day, and somebody responded and they said, "This is BS," except they didn't actually say BS. They said the actual what BS is an abbreviation of. And the reason was because the video was actually talking about business credit, and they said no. And somebody said, well, why do you think so? Because I used this program and got money. And they said, well, because I was asked to prove my bank statements, and because I didn't have enough revenue, I couldn't get approved. Well, they're right, because they went and applied for one kind of simple financing called cash flow financing that only looks at their revenue. And because they didn't have the revenue, and they said they had perfect personal credit, credit, well, then they still could have got financing, but that one lending source couldn't help them because that one lending source only dealt with cash flow financing. And in today's lending environment, this is the problem we see. What we see is conventional banks need all three, and then we see individual lenders only offer one of these three: credit-based financing, cash flow, or collateral-based financing. So the problem is, if you go to the wrong source and you have good credit but don't have cash flow, and they offer cash flow financing, well, then they would deny you. Even if your credit score was 850, they couldn't help you. Or if you went to an unsecured lender that was made decisions based on credit and you had $1 million a year in cash flow, but you didn't have good credit, well, they couldn't help you because these individual lenders only deal with one of these, not all of them. So that's one of the benefits of being part of our program, is that you have access to all of the programs. You have access to all of the legitimate financing sources out there. So if somebody has any kind of lendable strength, they can get a loan, whether it be a loan or credit line. And if they don't, well, then we can default to business credit, which we'll talk about a little bit later as well. So to dive in, let's talk a little bit more about cash flow-based financing. So when we talk about cash flow-based financing, we're talking about two different kinds: using bank statements, which has to do with revenue financing, we call it, or merchant advances. And I apologize here for my my graphics. I had my assistant Sarah put these on at the last minute today. She was getting ready to go to bed, and she obviously used images that were a little too small for the slides. They might look a little blurry on your end. And then we also have being able to verify income from tax returns. And this offers all kinds of alternative SBA venture capital, which we'll talk about. And it also provides access to SBA loans. So if somebody has money coming in the business and it's consistent, then these are the type of financing they can get. If they could verify that through bank statements, well, it opens up revenue and merchant advances. If they can't, and they can, and they have tax returns on top of that, well, then that opens up alternative SBA and SBA loans. So let's look at the first of these: revenue lending and merchant advances. Now, I'm putting 3 stars beside revenue lending because this is one of the most popular programs that we provide access today. And what we find is that, we have a program that deals with really bad credit, which is revenue lending, which is very popular. And we have a program that deals with very good credit, which again is a very popular program of the many, many, many that we offer. So I'm just got this starred, and I'll star unsecured lending when we get there as well, because that's another really popular program. So this is fast money. Revenue lending, merchant advances. Well, first of all, let me talk about the difference between the two, because you'll see both of them out there. Revenue lending is what we like the best. Merchant advances have always been historically probably most popular. The difference is this: merchant advances will only look at somebody's deposits in their bank account that come from credit card transactions. Visa and MasterCard, that's it. So they look at all the Visa, MasterCard, sometimes Discover, but usually it's Visa, MasterCard deposits into your bank account, and that's what they'll count as your revenue that you can qualify you for financing. Revenue lending looks at all of your deposits. It looks at cash deposits. It looks at check deposits. It looks at Visa and MasterCard and Amex and Discover. It looks at your total overall deposits. And because of that, it shows that you have more revenue, and usually you can get a greater amount of financing. The other reason we don't like merchant advances as much is because with merchant advances, the borrower is often expected to change their merchant account. So what happens is the lender says, okay, look, we're going to give you a merchant advance. You have to change your merchant processing account. Whoever accepts credit cards and you process credit cards through now, you have to change that person from whoever it is to us. Okay, now maybe that's a problem, maybe it's not. For me, it's a huge problem because I'm a really loyal guy. So like the people that give me the merchant account in the very beginning, when I'm opening the business, when it's the hardest point to give somebody a merchant account, that's the guy that I want to stay with me. I'm not going to betray him and leave him unless I'm really like walked over and taken advantage of. But as long as they're treating me good, I'm going to stay with him because they gave me a shot in the beginning when others wouldn't. And then all of a sudden we establish all this merchant processing history, and all these other guys want to come in and steal that guy's business. Well, that's just not how I personally work. Everybody's a little different. But I don't think people should be expected to change their merchant account to get money, which is why we prefer revenue lending over merchant advances. So this is super fast money. You can get money usually within 3 to 7 days. And no, that's not an exaggeration. We've had a client that literally got money in 24 hours because they needed to meet their payroll. Actually, it was a little bit more than that. They called late in the day on Monday and needed the money Wednesday morning, and it was done. So when I say 3 to 7 days, that is actually extremely doable. The only thing that would delay that beyond that is the customer dragging their feet. They don't get the application in. They don't get the bank statements in, whatever it may be. So it's very fast money. It's also very easy money. And by easy, I mean, there's just not a lot of hurdles somebody has to go through. There's very little income documentation. They can get approved with a 500 credit score. They don't need any collateral to get approved. So as long as they have consistent deposits in their bank account, they pretty much stand a very good chance of getting approved. So all that they look at is they're looking at 6 months of bank statements and typically sometimes merchant statements as well. So the merchant statements is what you get from your merchant account provider that says this is how much you did in credit card transactions. So they usually like to see those as well as 6 months worth of bank statements. And what they're looking for is two things, really. They're looking for deposits that are consistent. They don't want a real estate agent that has 2 deposits in a month for $70,000, right? Because real estate agents have, big commissions, not 70 grand, probably an exaggeration, but they have big commissions only a couple times, maybe a month. They want to see consistent deposits. They want to see the surfboard store that sells stuff every day and every day they have money coming in, or the business that has constant credit cards being processed every day and has bunches of deposits in their bank account. That's what they're looking for. They're looking for somebody that's depositing not a lot, but 5, 10, 15 transactions or more a month. And they're also looking for stability, that you manage your bank account wisely, that you don't overdraw the account, that you have some positive funds left over at the end of every month. So they're also going to lend up to about 12% of the annual revenue. And the range is typically about 8 to 12% of the annual revenue is what a cash or revenue lending lender will typically lend, and merchant advance lender as well. So what they're looking at is usually they'll do what's called a daily payback. And with a daily payback, then somebody basically gets money deducted every single day of the month that's a working day. So let's say Monday through Friday, basically, let's say that your daily payback is $100 a day. Then they take a payment, $100 on Monday, $100 on Tuesday, Wednesday, Thursday, Friday, nothing Saturday, Sunday. Monday starts over the next week and they take $100 each day. So daily paybacks are normal with this kind of financing, but you also can, and we deal with lenders that actually offer weekly and even monthly paybacks, which are very rare with this kind of program, but it's going to depend on risk. And we'll talk about what determines high and low risk here in a minute. But what we're talking about is that usually they take money out every single day of that person's bank account, Monday through Friday. They can also do it once a month or once a week. It depends on the risk of that actual borrower. And we'll talk about what determines risk here in a minute. So these are short-term loans, 6 to 18 months. Usually in the very beginning, the first time you come and get one of these, they're usually going to offer you lower, shorter terms, 3 to 9 months typically. Then as you come back and you get a second advance or a third advance, meaning you paid off the first one or you paid half of it off and now you come back to get more money, or you're just lower risk. You have better credit. You've been in business longer. You manage your bank account wisely. Well, then they'll usually offer you the longer terms, the terms of 9 to 18 months. Now, what's interesting about this kind of financing is this. It's expensive money, as we'll talk about, but most people would rather pay more money in a fee or more money back to the lender and get a longer term because their payments are lower. So we often see that people choose the path of lower payments, even if it means they get charged more money. And that's how these loans work. The customer usually gets choices. They usually get 2, 3, 4 options of how they want to pay. They can pay, for example, a 6-month term at a 25% rate payback, or maybe they can get a 12-month term at a 35% rate payback. So they can get a longer term if they're willing to pay more to get it. And again, from our experience, most people are willing to make that sacrifice. They'll pay more of a total fee to get the longer term. But again, the more they've proven themselves with the previous kind of advance, the better their chance they're going to get for getting a longer term. Loan amounts up to $500,000. And again, we're talking about they're getting roughly 10% of what their revenue is. So if they do $5 million a year in revenue, then they would get a $500,000 advance. And yes, I have seen these. Yes, we have done these 400,000, 500,000 range. I remember a student loan company that we did one for close to 500,000 for. So these are definitely doable. It's 10% of the revenue. So they might get 20 grand or 10 grand. We've seen an $8,000 advance because they had very low revenue, all the way up to a $500 million, depending on what their deposits are through their bank account every month. Now, over 70% of these we see come back to get more money. So what happens is when you pay off half of the advance, then you can renew it and come back and get more. So let me give you an example. They might give you a 6-month term. And they say, okay, we're going to give you a shot. We're going to give you a 6-month term at whatever your payback is. 3 months into that, you've paid off half of what you borrowed because the term's 6 months. 3 months is halfway through. You paid off half of what you borrowed. Then what will happen is the lender will go, okay, you've done a good job. You paid half off. We want to give you more money. But since you did so good on the first one at 6 months, now we're going to give you a 12-month term. So what's interesting is if you got $50,000 at a 6-month term, then you paid off $25,000 in 3 months. Now they come back and go, we're going to give you another $50,000 and we're going to extend the term to 12 months. So because your term is longer, they're going to give you more money and your payments don't change a lot when you get a second or third advance because they typically will charge you less of a money and fee and give you a longer term. So this is why so many people come back and get more money. Maybe your daily payback was $100 and then all of a sudden they say, we're going to give you another 50 grand, but we're going to lengthen the term to 12 months instead of 6. So that extra 50 grand will only cost you $113 now versus 100 like you were paying. Well, that's a heck of a deal. You only pay a little bit more per month because the term is longer and you get another 50 grand. So because it's so convenient, and usually at that point, they only want 1 to 3 months recent bank statements. So it's super easy. And these are the ones you get done in 24, 48 hours because boom, the person's proved himself. They look at the bank statements. Yep, you use the money wisely. Your revenues are going up. Here's more money in your bank account in 24 to 48 hours, about 70% or higher. We see 70 to 80% of people that we do a loan like this for come back and get a second, third, fourth, fifth, sixth loan. They continue to get more and more because it's so convenient for them to do so after the first one. Rates range wildly, 10 to 45%. And I say 10, but I've actually seen rates lower than that, as low as 8% on these kind of advances. What made the rate so low? Risk was low. The borrower's credit was really good. They had good time in business, and they managed their bank account really well. By that, I mean they didn't have any non-sufficient funds. They never overdrew the account, and they always had a pretty healthy balance in their actual physical bank account. So a lot of people might say, okay, well, there we go, right? You only need money. You only get money when you don't need it. Well, in those situations, people are they've got money in the bank. They want more money in the bank to start taking bigger risks. Maybe they've been testing an advertising campaign. They know it works. Now they're ready to put 10 grand a month into it, but they know it's going to be 60 to 90 days before they get the return on their investment. So they borrow the 50 to put it in the account to give them a buffer while they go all in on an advertising campaign or hire for a new position that they have already tested they know is going to do really well, but maybe produces 60 or 90 days for results. There's a lot of reasons that somebody with a really healthy business would still get something like this. And again, the lower risk, the lower rate. But we see these as high as 35, 45% payback. What does that mean? What that means is it means if somebody borrows 100 grand, well, then if they got a 10% rate, they pay back 110. If they got a 45% rate, they pay back 145. So again, a lot of that depends on risk. Risk includes time in business, industry, the credit quality, how they manage their bank account. Do they have non-sufficient funds? What's their daily balance on average, their ending balances, etc. Fees and interest are 100% tax deductible. So all the money they pay in fees, they get as a direct write-off on their taxes anyways. So affordability is really what matters. And it's, to me, the same as a mortgage, right? When you pay a mortgage payment, you get 100% of the interest you pay back as a tax deduction. So you get it all back at the end of the year anyways. So what really matters is affordability. If you can afford the payment, if it makes sense, if you're going to use the the money to do something smart to grow your business, well, then it might make sense to pay 30, 40% because you're getting all that money back as a write-off anyways. If you can afford the payment and it's going to help you boost and increase your business, then in a lot of cases, that type of financing really makes sense. 500 credit scores are accepted. They can't currently be like in a bankruptcy, but it takes about something that severe for somebody not to get approved for credit issues. Rarely ever do we see people declined because of credit issues. You have a 500 score, you're typically going to qualify for this kind of financing. You've got to have 120,000 or more in annual revenue. That's about 10 grand a month or more, usually. With compensating factors, you can even get approved with as low as 5,000. So you might see advertisements out there that say, hey, if you have 1 year in business and 5,000 a month in revenue, we can still get you approved. Well, that's because they're expecting that you have compensating factors. You have good credit. You have good time in business. Those type of things might compensate for the fact that you don't have the 10,000 in revenue. But if you come in with a 500 credit score and 5,000 in revenue and a year and a half in business, you're not going to get approved. Okay, so yes, 10,000 is normally the requirement to get this kind of thing. If you have 10,000 a month in deposits in your bank account, you can go as low as 5,000 if you have some other kind of compensating factors. They usually want to see 12 months in business. Again, and I messed up this little sub point here with compensating factors. Banks can go down to 5 months. That actually should say 6 months. So 12 months of business is the norm. But if you have some kind of compensating factors like really good revenues, really good deposits, consistent deposits, lots of money in your bank account left over, good credit, any of those type of things, then they might consider doing an advance for you, even if you've been in business as long as 6 months instead of a year. And they really want to see some kind of consistent deposits, 5 or 6, not like a real estate agent or somebody that only has 2 or 3 a month. They really don't want to see a bunch of non-sufficient funds. I say 10 on here, but it really varies depending on the other factors involved in the deal on how many are truly acceptable to get. You need to have a positive bank balance at the end of each month because they're taking money from your bank account. So if you have negative in your bank account every month, then how would it make sense for them to start taking money and you add a loan payment into that? So they need to see that you have positive ending bank balances. And if you are part of our partner program, and you're part of our direct funding aspect of our partner program, which if you're not familiar with that, you can email eric@creditsuite.com, ERIC, eric@creditsuite.com, and Eric can tell you more about the direct funding program. So if you are actually a partner of ours and getting paid on the direct funding program, you can make about 3 points on this kind of deal if your customer comes in. So what does that mean? It means if you submit a customer in to get financing or you sell a business finance suite and the customer ends up getting financing, if you're part of the direct funding program, you could get paid about 3 points. So to give you an example, if the customer got a $100,000 deal, 3 points is 3% of that, which is $3,000, right? If it was a $50,000 deal, 3% of 50,000 is $1,500. So that gives you an idea if you're part of direct funding on the money you can make. I'll go over that on every deal as well. Alternative SBA and venture capital. This is where funds are basically coming from private investors or alternative lenders. You don't have to have any collateral required typically for this kind of approval. Unlike conventional loans, you can get 50 to 500,000, the same as actual what we just talked about with revenue lending. But these are longer loan terms, 2 to 4 years. And longer loan terms mean lower payments and an 8 to 25% rate typically. So the fees on this are usually half as much as revenue lending, and the loan terms are usually twice as long as revenue lending, which, by the way, I should bring up that you can actually come in and get a 2-year loan term as well on an actual revenue lending deal. We actually have deals where we do $250,000 revenue lending deals at 2 years now. So that is possible, but you can usually get a 2 to 4 year loan term and 8 to 25% rate, depending on the risk. And looking mostly at high profit margins. What they're looking for is your tax returns. So that you're going to have to provide 2 years of tax returns, and they need to show profits. If you have tax returns that show profits, even if it's not a lot, but it's some kind of profit, then you're typically able to get approved for this kind of financing. Again, we've seen people approved for $200,000, $250,000, and they didn't have a lot in profits to show, but because they had profits on their tax returns, they were able to get approved. But you got to have good credit. So that's the kicker with this. If you have credit issues, then or your customers have credit issues, they can get revenue lending or merchant advances. If you want longer terms, low rates, then that requires good credit and tax returns to get SBA, alternative SBA, venture capital type money. Basically, you've got to have good credit and financials are needed for approval. And again, if you're part of the direct funding program, you can make about half points on that as well. So you've got to have 2 years of personal and business financials to get approved for an SBA loan. This is what you're going to typically find at a conventional bank. So with SBA, these are the loans you're going to walk into your bank, and you don't go to SBA to get a bank loan. You go to a conventional bank. And at the conventional bank, then what will typically happen is SBA will then guarantee or insure that loan in case you default. And to get approved for these are some of the hardest to qualify for, because you've got to have tax returns for 2 years. You've got to have business and personal financials. You've got to have really good credit, typically preferred 780 or higher. Your profits you should be profitable on your tax returns. As a matter of fact, in a lot of cases, these loans are based on the profits that you're actually claiming, the amount you get. And you got to have positive financials that show that you're increasing from year to year, that you're getting better, that you're making more money from year to year. Collateral for about 50% of what's being borrowed. So you've got to have collateral as well for SBA. And you can also make some money on SBA loans as well. But these are pretty common because of these requirements. There's just not a lot of people that have the good credit, the cash flow, the collateral, the tax returns that show profits. So usually these are pretty well established businesses making millions of dollars that will typically qualify for an SBA loan, which is why we're going over so many different programs today, because there's so many options if you don't meet those actual requirements. So almost everyone you speak with is going to usually want a credit line. Most people we talk to are looking for credit lines. But to get a true credit line, you've got to have similar qualifications to SBA. You've got to have collateral. You got to have excellent personal and business credit and extensive financials. Actually, that's a little bit inaccurate. You can actually get these without the collateral part in a lot of cases. What you're usually going to need is excellent personal credit and really good financials. That's the key to credit lines. So if you want a credit line, then don't worry. There's plenty of unsecured card options we'll talk about later. But if you want a real credit line, you've got to have good personal credit. You have to have good business credit. You have to have good financials to really stand a chance of getting an actual credit line. And the collateral net profits per the tax returns for the last 2 years determine the approval in a lot of cases. So usually the lender's going to look at how much you're claiming on net profits. And in a lot of cases, that's pretty equal to what you might actually get a real credit line for. Credit-based financing. So we talk about credit-based financing. We just finished the first C, right? If you have cash flow. If you have cash flow, we talked about what you could use your bank statements to get, revenue, lending, merchant advances. We talked about what you could use your tax returns to get, SBA, alternative SBA, venture capital. So what if you don't have your strength being cash flow and the strength is credit-based financing? What if your client has good credit but doesn't have consistent cash flow? Well, then that offers up two different kinds of unsecured financing. And the first is personal credit cards, and the second is business credit cards. And for the personal, they need a little worse credit, 670, 700 range. And to get real business cards, which we're going to talk about in a second, they're going to need 700 plus credit scores. So unsecured personal cards, they can get 10 to 150 grand. They can usually get 5 times the amount that they get at their bank or trying to go out on their own, and 5 times the amount of the highest credit card limit account they have reported now. So if they have a $10,000 credit report on their credit report now, a credit card on their credit report now, they can usually get about 5 times that, which is about $50,000 in financing. But these report to the consumer credit reporting agencies, not the business credit reporting agencies. But they do get 5 cards. So instead of one credit line, what we're doing is making it easier for them to get the high amount of money by splitting it up into 5 individual cards. Those cards kind of create competition where the banks compete against each other, making it easier to get the limits raised and get more and more money. And I had this happen the other day. I applied and got 2 business credit cards, an Amex card and a Capital One Spark card. And I went to one, I'm not sure which one. I said, look, this other one approved me for significantly more money. Can I get my limit raised? Because I would have a tendency to use your card more if I did. Huge valuable lesson here. And they said, absolutely. They raised our limit 50% just because I asked. And I had just got the card in the mail that day. Now, I did the same with the other one, and they said, nope, your card's too new. We won't do it. So I'm not saying this works all the time, but it's worth asking when you get a new credit card, calling and immediately asking if you can get a higher limit. Because I've learned just because you ask, oftentimes they'll raise your limit 25 to 50% or more just because you actually ask, especially when they know you have other credit cards. And why is that? Well, we all know Because don't we all have a tendency to use the cards that give us the highest limits? If you have a $4,000 credit card limit and a $10,000 credit card limit, most people default and use the $10,000 limit. Okay, especially people that know anything about credit, because that affects their utilization less. But even if you don't know things about credit, it still makes sense because, hey, we like that. If we have a $10,000 limit and a lower balance on our credit report, then it makes sense. And it makes a lot of sense for them to then move forward with the higher card. So card issuers get this, and that's why just by asking, it's easier to get approved for higher amounts, especially if you have multiple credit cards. Usually you're going to get a 0% rate for 6 to 18 months, so it's great for a startup, and normal rates after that for credit cards, 5 to 25% like you would with any other credit card. Okay, now 8 to 12% success-based fee. We don't charge any fees on financing, any financing we do, period. Okay, but the lenders charge points, they charge rates, they charge however they charge. With this kind of program, the lender's typically going to charge 8 to 12% success-based fee. So that means they charge you based on how much they get you approved for. And let's just average that out and say it's 10%. So if they get you $50,000, then they're going to invoice you for $5,000 once you get your business credit cards. Or your personal credit cards. If you have $100,000 in financing, well, then they're going to send you an invoice for $10,000. But keep in mind, you're paying 0% for 6 to 18 months. And also keep in mind, they're usually getting 5 times the amount that they're getting on their own if they went to apply. And we actually had this happen. So we had a client that had 800 credit scores and had decent financials. And they said, I'm not going to pay a lending source 9%, I think was the fee to get this done. I'm not going to do it. At least we tried to explain, listen, you're going to get 5 times the amount here than you'd ever get on your own, 0% rates, They said, nope, nothing to do with it. Now, this was actually the next program I'm getting ready to describe, the business credit cards. And we said, okay, we'll help you get approved at your bank then. And we did. We helped them get their financials, their application. We helped them get everything together. Well, the unsecured source that could have got them the business credit cards that I'm about to tell you could have got them $75,000. They were pre-approved for $75,000. They walked into their bank. They didn't have to pay a fee, but they only got $12,500. And the problem is, once they got that $12,500 at their bank and that inquiry went on their credit, the $75,000 they could have got went out the window. So that's what you got to determine. Yeah, you could even go to your bank and get 1/5 of this amount, but you're going to pay no fee, but you only get 1/5 of what you could have got. You work with a specialist or a lending source that specializes in this kind of financing. You can usually get 5 times the amount that you usually get directly with the lender. For the personal cards, they need 670 to 700 credit score range, because remember, this is based on personal credit. They need utilization under 50%. They need to have less than 8 inquiries on their credit report in the last 6 months' time. So the business cards I'm about to show you are more stringent. They need 700 scores. They need under 30%. They need less inquiries, but I'll talk to you about that in a minute. So this is a little bit more lenient requirements to get approved for. And it's really one of the best ways to get a lot of money without cash flow or collateral. So even as a startup, it's a really good program. And usually you'll make about 2 to 3 points if you're a partner with us, part of the direct funding program. So this is the most popular. This is another one of the most popular programs that we offer beyond revenue lending that we see a lot of clients go with. They get 10 to 150 grand. Okay. Again, you're getting 5 times the amount of the highest credit card limit that's on the credit report now. But here's the kicker. These only report to the business credit reporting agencies, not the consumer. Now, listen, I have a lot of partners on this call, so let me clarify. I am not talking to you about business credit. The Business Credit Builder provides a step-by-step system for people to build business credit. That business credit does not require a personal guarantee or a personal credit check for approval. Not at all. We consider this to be a loan program. We do not consider this to be business credit. But a benefit of this loan program is that these cards do report to the business credit reporting agencies. So this is actually a pretty cool way for somebody to expedite building their business credit. They can skip the initial vendors that they would typically use to build their initial business credit. They could get these, put 5 high limit cash accounts on their business credit reports. Then they could skip vendors and start getting high limit store accounts very quickly. So it's a way to expedite their business credit building, but we don't consider this to be real business credit because it requires good personal credit and a personal guarantee for approval. Now, this is important to note because everybody classifies corporate credit and business credit a little bit differently. And we see sources out there that promote business credit being these kind of cards, but we don't really consider this to be real business credit, because this kind of credit, you've got to provide a personal guarantee. You've got to have good credit for approval. So in our world, that's not real business credit. Real business credit is credit you can get without a personal guarantee or credit check. But the benefit here is they do report to the business credit reporting agencies. So not only can somebody get a lot of money, but they also build their business credit at the same time. So they get money and they build their business credit. And they can usually get up to 5 business credit cards, just like the personal card. So again, it creates competition. 0% rates for 6 to 18 months, or for 6 to 18 months, and normal credit card rates they'll pay after that. So 8 to 12% fee, as we just talked about, the same as the personal cards. The fee varies again based on risk. And they'll need a good credit to qualify. 700 plus credit score, utilization under 30%. That means they're utilized individually, and overall, what they owe on their credit cards is less than 30% of the actual limits on those cards. They've got to have less than 4 inquiries on their credit in the last 6 months. So see, this is why I'm talking to you about both personal and business cards. Our preferred method is business cards. Why? Because we're business credit guys. We love business credit. I mean, we love things that report to the business credit reporting agencies and not the consumer reporting agencies. But the consumer credit is easier to qualify for, the program I just talked to you about. This one's a little harder to qualify for because of the utilization, inquiry, and credit score requirements, but it's phenomenal because somebody can get a lot of money and build their business credit at exactly the same time. And it's one of the best ways to get high amount of money when they have no collateral cash flow. And it works for even a startup business. How much money can they get? They can get up to $150,000 for this program. That's insane. You're talking about somebody getting up to $150,000. And yes, we see people over 100 grand in that range all the time. They get over $100,000, $100,000, $150,000 in 0% cards. Perfect for a startup or business that needs to keep their payments low. And much like credit lines, they can put money on these cards, pay them off, and have access to reuse those cards as much as they'd like. So I personally like revolving credit better than loans. I'm only paying on what I borrow, and I have a choice. If I want to put $50,000 on the credit card and then pay it off, then I can reuse that credit card and put another $50,000 on there. So they're more versatile than what you'd find for a loan. And it's pretty cool to be able to get up to 150 grand at 0% just because they have good credit or a good credit partner, somebody that can vouch for them as a guarantor, basically. And again, if you're part of the direct funding program as a partner, you can make 2 to 3 points on this program as well. So collateral-based financing. So we talked about 2 types now. We talked about cash flow financing, where if they have verifiable income through their bank statements or tax returns, what that could mean. We've now talked about the second C of lending, which is credit-based financing, if they have good credit or a good credit guarantor. Now we're going to talk about the third type of financing, which is called collateral-based financing. And this really has to do if they have any type of viable business collateral or some types of actual personal collateral. So acceptable business collateral is account receivables or purchase orders or a book of business if they're an insurance agent, or equipment or inventory, or even commercial real estate. Acceptable personal type of collateral is stocks, bonds, and other securities, and 401k. And sometimes people ask, can I use my home as collateral? Not typically for a business loan. I've seen one lender out there, and they never really were able to do any business. We sent them, so we don't really actively use them now, that says they would use a personal home if the person had good credit and tax returns, but we never saw them actually close a deal. So I have seen that out there before, and SBA loans will let you use a home as collateral because they require collateral for approval. But usually personal homes can't be used as collateral. Vehicles can't be used as collateral, whether you have a trailer, whether you have a tractor trailer, whether you have a truck or a lawnmower. Those types of things are depreciating assets, vehicles are. So that type of stuff won't work as collateral, but stocks, bonds, 401ks on the personal side absolutely can. So receivables are used as collateral with AR financing, and you can usually get 5,000 or all the way up to 20 million. And what happens with receivable financing is somebody's getting advanced to them up to 80% of their receivables within 24 hours. So let me give you an example. If And I always use the same example because I think it's a perfect example. A buddy of mine does all the plastic mugs for Busch Gardens. So those really fancy mugs that you spend like $10 for a drink, he makes those. So Busch Garden gives him a big order. He's got to get the plastic. He's got to pay his team to manufacture the glasses. He ships the cups to Busch Gardens, and Busch Gardens waits 90 days to pay him. So he gets a big order. It's a fantastic thing because he knows he's going to get paid, but he also knows it's going to be 4 to 5 months before he gets paid, and he's got to front all the cash to buy the supplies and to actually get the machines running, pay for the factory to be open, do all the things to wait during that 4 months to get paid. With account receivable financing, if he got a $100,000 order from Busch Gardens, the lender would give him $80,000 the next day. Here you go. Instead of you waiting 4 months for your 100, we're going to give you 80 now. Then when Busch Gardens pays us the money, because we'll even collect on the invoice, we'll give you the $20,000 minus our fee. Okay, so that's how account receivable financing really works. And it's usually a 1.25% to 3% discount is what they call it, which is what they call the actual fee. And they usually pay a 4% fee in the beginning when they first start AR financing. They don't have any credit score requirements, so credit doesn't matter on the personal side. Receivables have to come from another business or government agency. So if you mow people's lawns, residential lawns, you couldn't do this. If you mow lawns for big businesses, well, then you could actually qualify for AR financing, to give you an example. You just can't have account receivables from actual individuals. So if you're a credit repair company, you couldn't do AR financing because you're accepting payment from actual individuals. But if you're a company that deals with businesses and they're the ones that owe you, or the government, well, then you could do AR financing. You've got to be open for 1 year to qualify for AR financing typically. The most common types of AR receivables are medical receivables and construction receivables. They call everything else conventional. So think about how this could be used. Think about big builders, or think about a plumber that does work for U.S. Homes or a big builder. Well, they might have to wait months to get paid from that builder. So they're a perfect candidate for AR financing. Think about a doctor's office. How do they get paid? Medicare, Medicaid, insurance companies. You think Medicare, Medicaid, and insurance pays fast? No, the government never pays fast. They could wait months to get paid, but they could use AR financing, and the actual lender collects from Medicare, Medicaid, and the insurance companies the payments and advances them the majority of that money the next day. So AR financing is very, very, very popular with those two industries because they commonly deal with so much AR. But medical, they need to have about $600,000 annually in account receivables to qualify. The other industries don't have nearly that. It's such a pain to collect on Medicare, Medicaid, and health insurance that medical AR lenders want you to have a lot to be able to actually lend. And again, you can make about 0.5 point on this if you're part of the direct funding program. Now, if you're asking and your partner saying, well, wait a second, why can I only make 0.5 point on this and 3 points on the other? Well, it just depends on what they pay out. A lot of lenders in these type of spaces only usually pay out 1%. And what we're doing is we're doing all the work and just splitting the fee with you. So that's why when you see 0.5%, that typically means that they're paying 1%, and then we're doing the work to get all the deal approved and taking 0.5%, and then you're getting 0.5% for bringing the customer in, just so you know that. Okay, so purchase order financing, $5,000 plus. You can get up to 95% of a purchase order can be advanced. The rest is paid when the fee is paid. So what are we talking about purchase orders? Well, let's say that you're a t-shirt manufacturer, and what you do is you embroider t-shirts, and you get a really big order, and you have to go buy the t-shirts from a supplier to embroider them. Well, you could get purchase order financing to where the lender pays for the actual, or gives an order of credit or a letter of credit to the actual t-shirt supplier, then gets you the t-shirts, then you can actually do the embroidering, collect your money, and then pay the lender off. So they're giving you the money to buy what you may need to produce the order, so you don't have to pay that money out of pocket. Think about that. That's a big deal to people because that saves a lot in cash flow. Like if you get a $100,000 order from Busch Gardens or a $100,000 t-shirt order, to front all that money and wait to get paid is a really, really big issue. Then you have to worry about the collection part too to make sure you do get paid. Well, in this case, the lender's doing the collecting and the lender's fronting you most of the money. So it really puts a big ease on cash flow, letting you continue to bring in more big orders instead of being strapped. Okay, 1 to 4% rate is what they typically charge. No credit score requirements to qualify. And again, as I mentioned, what happens is a letter of credit is initially is initially what's presented to the company that's getting paid. And it cannot be for unfinished goods, things that are part somewhere in between the manufacturing process where you're buying part of what's needed to manufacture the product. Application, copy of purchase order is all that's needed for approval, pays the same as account receivable financing. So another type of collateral-based financing is called book of business. This is where commissions from book of business serve as collateral. And this is only for insurance agents. Okay. And usually these are really good loans. I mean, if you know of any insurance agent that's looking for financing, whenever I even talk to an insurance agent, I mention this. I go, we offer book of business financing if you're ever interested in getting money, because this is one of the best loan products I've seen. The loan terms are fantastic, 3 to 10 years. They're usually paying 4 to 9% plus the prime rate. Okay, so the rates are actually pretty reasonable, especially considering the loan term that they're actually getting. And they can get approved with a 520 credit score. Now, they're typically wanting about average credit of 600, 650, but they can get approved as low as 520. And they can usually get approved for as much as 120% of the surrender value. What's a surrender value? That has to do with if they are a Prudential agent and they were to sell their book of business back to Prudential, then that's what they would sell their book of business back to Prudential for, is called the surrender value. But look, I can tell you this, today we do a lot of this kind of financing actually, and today I've never seen one case where the customer ever took the amount of money that they qualified for, which is the opposite of almost every other loan I've ever seen. And almost every other kind of loan I've ever seen, people want more than they can get. With this, they can usually get way more than they want. And almost everyone, actually every case I've seen, they take less than they're approved for. So they can usually get approved for a lot more than what they usually end up taking. State Farm doesn't work. It's just kind of the way it is, because they don't actually ever own their book of business based on the relationship that the company has with their actual agents. And again, that can pay you about 0.5%, but the loan amounts are typically higher. So this is a pretty cool program. So I'm a big fan of this program, because what happens with this program is, insurance agents can use this to borrow against their own book of business. The people, so if you're a car insurance person, you have a lot of people that renew their car insurance every year. Like I am. I'm with State Farm, and I renew every year and don't even think about it. And a lot of people do. That's what a book of business is. But what's really, really, really nice about this is that somebody's able to come in and get a large amount of money. They don't need great credit to do it. They get a really good loan term, and they can even use the book of business from an insurance agent they're looking to purchase to get the money to make the purchase. That's one of my favorite things. So if you've got somebody that's a Prudential agent that wants to buy another Prudential agent out or buy out another insurance company, they could use the other insurance company's book of business to get the loan to buy that company. It's pretty sweet. And a lot of insurance agents don't know about this, because there's only like 2 sources in the country that even offer this program. So if you're talking to want to know what industries can I target, this is a great one to do, because any insurance agent that's looking to expand, looking to get money for expansion, looking to buy out competitors, this is a fantastic program to be able to do all of those different things. Okay, so equipment financing, they can do a few things with equipment financing. They can use existing equipment to borrow against to get money, or they can get new equipment by either purchasing it or leasing. And financing and leasing are both available. They can go from small equipment, 10 grand, up to 2 million. I think we've even got programs that go to 10 times that, up to like 20 million. I've never seen anybody come in with equipment that's so much money that we haven't been able to actually help them get a loan. Good terms, 12 to 48 months, 5 to 55%. The rates are all over the board depending on risk on this. And they usually need a 580 credit score or higher for approval. They can get approved with, a 650 is what's preferred, but they can get approved with a 580. It depends on, are they a startup? Are they established? What are the other risk factors? And 2-year time in business is required for leasing, not buying. As a matter of fact, a brand new startup business can get a loan to buy equipment, just not for the actual leasing. And they can borrow up to 50% of the actual equipment value. So if the value of the equipment is, you got to be careful on this, because, in anything where something's being used as collateral, they're usually going to diminish the value of it. So you might have equipment that's worth 100 grand. That doesn't mean they're going to get 50. What it means is, it means the lender's going to say, okay, look, you got a $100,000 piece of equipment. If we sold this at auction, we'd only be able to sell for 60. So we'll give you half of that 60. We'll give you 30,000 using the actual piece of equipment as collateral. Okay, and what would happen is if they defaulted on the loan, then the lender would basically sell the equipment to pay off what was owed, and the rest could still go back to that person. But usually they're going to give it off what they could sell the equipment for quickly. Startups can get financing even to buy initial equipment. And again, if you're part of the direct funding program, you can make 0.5% on that kind of program as well. Inventory financing, again, there's only one lender I've ever talked to in the country that offers this program. As a matter of fact, I talked to the owner of that company because he saw we were promoting the program. And so we had a pretty cool program, or we had a pretty good discussion, because there's very, very few out there. I think he's the only one I've ever seen that actually offers it. 250 to 500,000 is what they can get in an inventory line of credit. So they can actually get a line of credit. So why is this important? Well, lines of credit are usually, as we talked about, reserved for people that have good credit or have good credit and tax returns. Well, inventory financing is one of those ways where they don't need either. They don't need to have cash flow or good credit, and they can still get a pretty hefty line of credit. 2 to 5% rates for inventory financing, and sometimes higher depending on risk. 520 credit score or higher. They've got to have $500,000 in inventory to qualify, because they're usually getting a loan amount for half as much as what their inventory is worth. So they're going to need at least $500,000 in inventory. They don't really play with, somebody that has 100,000 or 200,000 in inventory. But if somebody has a good chunk of inventory that's worth money, then they can qualify for this type of program. Good inventory management system. They need something that keeps track of their inventory so the lender can actually get a pretty good feel for what their inventory is actually worth. And again, you can make usually 0.5% to 1% on this kind of program as part of our direct funding program. So with this kind of financing, I like it because it's a line of credit. But they, when I talk about inventory, I'm not talking about people that have electronics, which loses value quickly. I'm talking about, a factory that has tons of inventory on the shelves, or a retail store that has tons of inventory in their back room. This is pretty cool. If you keep a lot of revolving inventory in your place, well, then you can get a line of credit borrowing against that for, $250,000 that you could use to buy more inventory or buy other things, which is really, really cool. One of my favorite programs that I see. Security-based financing. Somebody can get up to 90% borrowing against their stock value. They can get a 5-year loan or a credit line, and they usually pay prime, whatever the prime rate is, plus 2%. So it's often about 4 to 6%, depending on what prime is at any given time. 500 credit score, so really no real credit score requirements. Most stocks and securities are accepted with this kind of program, and they need, of course, proof of the stock statement and application. And this kind of program can pay you about 0.5% as well. Commercial real estate financing, $75,000 to $20 million loan amounts. They can usually get 55 to 65% loan to value. 2 years financial, tax returns, P&L, and debt schedule is what's needed. These aren't easy to qualify. Okay, we deal with brokers all over the country that deal with this kind of financing, and they're not the easiest to qualify for. To buy commercial real estate, you've got to have 2 years tax returns. You've got to have financials, P&L, debt schedule. Why they're wanting all this is you have to show that you have enough revenue and profit to pay the loan. That's primarily why they're getting all this income documentation. Businesses must have cash flow to make the payments. That's why they're asking for that. 650 credit score to get approved. You've got to provide a personal guarantee, and you've got to usually pledge some assets sometime in addition to the real estate to qualify, but pretty low interest rates. In a lot of cases, 4 to 5% interest. And again, loan amounts up to 20 million on the other end. We have a couple different types. We have SBA. We'll do some loans and some loans others. So that's why you see a range of 75 to 20 million here, 500 to 20 million. Depends on if we're dealing with an SBA conventional 504 type loan or an alternative lender, which we deal with both. And that, again, can pay you 0.5% as well. Stocks and bonds, actually, I just went over this. So that's not in their 401k. And I'm going to skip that actual because we just went over that. They typically need about $250,000 in stocks for approvals for this program. If they have a little less, then we can definitely do it. This is a program we're seeing become more and more popular. They can get up to 100% of what's in their 401k. It's a 5-year loan, although these aren't really loans. What they're ultimately doing is, instead of buying stock in other companies, which is what a 401k is, they're basically rolling it over and buying stock in their own business. Is primarily how this kind of financing works. And they usually pay the prime rate plus 2%. They can get approved with a 500 FICO score, so personal credit really doesn't matter. They will pay about a $2,000 fee. The lender rolls that into the loan, so they never pay that up front. and they don't charge any penalties. So it's an IRS proven strategy where they're not going to pay any penalties whatsoever for the actual financing, and they actually can pay you up to 0.5% if you're part of our direct funding program. So business credit, so we've talked about all 3 C's, right? Cash flow, credit, and collateral. If they have cash flow, we talked about the kind of financing they can get. If they have collateral, we talked about all the different types of collateral financing they can get. We talked about if they have good credit or a good credit partner, what type of financing they get. Here's the bad and the fantastic news. The bad news is if you don't have cash flow, credit, or collateral, you are not lendable. You will not get a business loan, period. Nobody offers any kind of business loan unless you have one or all 3 of those 3 C's. But the beautiful thing is that business credit's a catch-all. Business credit, you can get money for your business quickly through business credit, even if they don't have cash flow, credit, and collateral. And this is why if you're talking to potential customers, you want to go through an interview process. How is your cash flow? How is your credit? How is your collateral? Because in doing so, that's going to determine if business credit's a better fit or one of the other types of financing we just talked about is a better fit. So with business credit, there's a lot of benefits. They get immediate vendor approval. So they're starting to get credit to buy computers and office supplies and shipping supplies and things like that right away, regardless of their personal credit quality, without a personal guarantee. They're getting high limit revolving vendor, store, and fleet credit cards. So they're getting very high limit accounts. And usually people that have credit issues, well, they're not used to getting $2,000, $3,000, $4,000, $10,000, $20,000 credit card limits, but they could do that very quickly in the business credit world, getting credit that's linked to their EIN, not their social. There's no personal credit check or guarantee required. So it works perfect for people that, again, have credit issues, which this is the majority of people you're going to speak to. The majority of people out there we find looking for money don't have consistent cash flow or any. They have bad credit and they don't have any kind of collateral. And they're like, give me money. Well, it doesn't work that way. If you don't have a lendable strength, then we kind of have to create one. And business credit's how you create one. You build a good credit profile for your business that then makes you more lendable. And the beautiful thing is not only are you more lendable after you build it, but you also are getting money while you're building. You're getting real usable credit with very high limits, usually much higher than what you'd find able to get with the personal credit issues that one might have. No financials, no tax returns, no P&L, no bank statements, no revenue verification for the business is even required for approval, and it works for startups. So again, no cash flow, no credit, no collateral requirements. It's the only way to get money if those 3 things don't exist. Cash credit's also available, but sometimes requires a personal guarantee. Cash credit goes back and forth. Sometimes I'll talk to you about cash credit, a Visa, MasterCard they can use anywhere, being available without a personal credit check and without a personal guarantee. And then sometimes Discover will shut down those type of accounts, or Amex will make it harder to get those kind of accounts. And I talk about it and say, look, they're still available, but now we're kind of seeing a shift where now they want personal guarantees, or now they want to at least look at your personal credit for approval. But cash credit is available. It's just in some cases they still want a personal guarantee. In some cases they still want a personal credit check. But you're still able to get, again, high limit store credit cards, vendor credit accounts, fleet accounts, as well as what we just talked about there with cash credit. Reports only to the business credit reporting agency. So this could be utilized without any damage to the personal credit reports, which is big, because utilization is 30% of the consumer credit score, which means if you get a credit card with the limit of $10,000, well, let's be reasonable, $1,000 on the consumer side, then what's probably going to happen is, well, not probably, what's going to happen is if you use more than 300 of that $1,000 limit, you will hurt your credit scores. So by getting business credit accounts, then what can happen is somebody could wildly use it. They could max out the credit card, and it only reports to the business reporting agency, so there's no damage to their consumer credit. We see this happen so much, it's ridiculous. People have good personal credit, so they throw it out there, wildly use it. They get a bunch of credit cards. They try to fund their business. Then they go, oh my gosh, my personal credit scores are low because I have 50, 60% utilization. What do I do now? Well, the answer is you get business credit, because when you get business credit, those credit cards only report to the business reporting agencies. You could shift the balances from your personal to the business for whatever your business expenses were. Then that takes all that money off your personal credit card, your personal score skyrocket, and you keep your business credit separate than your personal credit, which is what business credit's designed for. Personal credit wasn't designed to fund businesses. That's why when you use personal credit to fund a business, you'll do a lot of damages to the scores. No personal credit inquiries. So you can get business credit without any inquiries being put on your business credit reports. And again, business credit determines really 3 very important factors. if you're going to get approved for a business loan, the amount of the loan or line someone will give you. So there's a section on Experian credit reports of the recommended limit that somebody should have. So I'll give you a kind of a funny story. I was actually on a podcast interview with a ridiculously nice lady. We were laughing and joking, very successful multi-million-dollar business. And I told her, I said, anybody could see your business credit reports. I said, as a matter of fact, I just pulled your Experian report while we're on this call. And she kind of was taken back, and it was kind of a funny moment. But when we got off the call, we started talking about it. And I said, well, I can pull anybody's credit. We could look at your prospects. She goes, well, pull my competitors. We pulled the competitors. We talked about when they had late payments. Hey, they were late this quarter of last year. What was going on? Oh, I know this was happening around that time of the year. And then she said, do me a favor, pull my husband's. And her husband had a 10-year business, had opened his business in 2006. His score was 29 out of 100. And his recommended credit limit was $1,000. He had a business open for 10 years, and the most money Experian was recommended that he be lent was $1,000. And I said, don't freak out. The reason his score is so low is because he has no business credit established. Experian knows he exists, but since he has no credit, they gave him a 29. We often see this. We see companies that have been around for a year or 10 years. They get 28 or 29 scores, which usually reflects that Experian knows they exist but has no credit scoring history, so they give them very low scores. We've actually seen people turn down with $3 million plus businesses for $10,000 credit card limits because that same thing happened. The bank pulled Experian, sees a 29 score, denies them due to business credit, even puts the denial reason as business credit, when the reality is they just had no credit established. That's why they had a 29. So yes, Experian recommends on their reports how much somebody should be given in credit. It's very important. That's why business credit is important. And they also determine the term, how much you're going to get approved for, how much you should get. Will you get approved? How long should your loan term be? Business credit determines all these things. So again, business credit is pretty awesome because it's a catch-all. It's the only way somebody can get money if they don't have cash flow, don't have credit, don't have collateral, and it also determines the rate terms that somebody's going to get if they do have one of those three. So it's important either way. Look, if you don't have cash flow, credit, or collateral, then your customers need to know business credit's the only answer that will work. If you do have cash flow, credit, or collateral, congratulations, you might get a business loan. Business credit determines how much you'll get in the term you pay. So you can't ignore business credit. If you do, you're going to continue to get money if you can get it at worse terms, higher rates, less money if you get approved. If you don't have business credit and don't have cash flow, credit, or collateral, you just won't have any way to get money. So that being said, that kind of wraps up. Now you know how to qualify a customer for financing. Do they have cash flow? Do they have credit? Do they have collateral? One of the 3 C's. If they do, you now know what kind of financing they can get, the rates, the terms, the qualification. If they don't have cash flow, credit, and collateral, you know business credit works, and you also know the benefits of business credit. And even if they do have cash flow, credit, or collateral, you also know the importance of business credit because that really has to do with whether they'll get approved, the rates and terms that they'll pay, as well as the actual rate or the actual term of the financing. So I'm going to open this up, see if you guys have any questions. Hopefully you got a lot of good information out of today. I'm going to wrap this up probably in about 60 seconds or less. So if you have any questions, get them typed in. I'm going to do a last call for questions. So as you can see, one of the cool things about being a partner with us is that unlike a lender that offers one kind of financing or a conventional bank that requires cash flow, credit, and collateral for approval, we really have a massive selection where we can help the majority of people. If they have cash flow, we can help them. If they have credit and no cash flow or collateral, we can help them. If they have collateral and no cash flow or bad credit, we can help them. As long as they have one of those 3 C's, they can qualify for financing. And here's the best news. If they have more than one of those 3, let's say they have 2 or 3 of those 3 C's, then that opens up even more financing options for them. Okay, so I'll talk about a story where I had, a client that needed $400,000 to get a tax lien. Everybody turned him down, 580 credit scores. But because we combined private money and we ended up helping them with credit and getting them unsecured, and we ended up getting them about 7, 8 different types of financing and ended up being well over $1 million, opened up a second second practice, a real success story. And this only happens because we're able to combine a lot of different programs for somebody that has more than one of those 3 C's. So if they have one of the 3 C's, cash flow, credit, or collateral, you can typically qualify for financing. If you don't, you can qualify for typically business credit. And if you have more than one of those 3 C's, you can typically qualify for even more types of financing than just one, and business credit as well. So a lot of different options for you and your customers. So I don't have any other questions. I'm going to wrap this up. If you do have any questions, make sure you reach out to our team. Our team is probably reaching out to you as well on a regular basis. We're here to help. Anything we can do to help you be successful in the space of business credit financing, we'd love to do so. Thanks, everybody. Have a great day.